Good evening, members and guests, and welcome to our fund and investment update. It's fantastic that you could take some time out of your day to hear about what's been happening with your super fund. My name is Kate Farrar and I'm the Chief Executive Officer of Brighter Super, and with me tonight we're lucky to have Mark Ryder, our Chief Investment Officer. Before I start today's briefing, I'd like to acknowledge the traditional owners of the lands on which we're meeting and pay my respects to their elders past, present and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role in this region. Tonight's presentation, which will run for around an hour, is designed to provide you with an update on the fund itself and, very importantly, our investments. If you'd like to ask questions, you can submit your question by clicking on the blue hand at the top of your screen. I'd like to also advise you that the information we're presenting is general information and advice only. It's been prepared without taking into account your individual objectives, financial situation or needs. You must not rely on the information alone as a sole or primary source of advice or guidance for the purpose of making decisions about your superannuation options. So the 2022-23 financial year is now behind us, and I can look back with pride and say it's been the most memorable and successful year in our fund's history. Over the last 12 months, we've completed the transfer of both Energy Super and Suncorp Super into Brighter Super. We've more than doubled the size of our fund, and in the process, we are reviewing and picking the best possible services and products from the three merged funds to support your journey to retirement. On the 1st of June of this year, 130,000 Suncorp Super members officially became Brighter Super members. So I'm really delighted to welcome all of you to the fund and also to your first fund and investment webinar. When we acquired Suncorp Superannuation business in 2022, it was the first time in Australia that a not-for-profit fund had acquired a retail fund. With the transfer of members to Brighter Super now complete, our former Suncorp Super members can benefit from being part of a not-for-profit industry fund where the focus is on lower fees and better services rather than profits to shareholders. You may not know that the transfer of Suncorp Super into Brighter Super happened 30 months earlier than planned. This is because we looked at our members' best financial interests and recognised that moving this transfer forward would give our current Brighter Super members and former Suncorp Super members the earlier advantage of larger scale and a more diversified portfolio. It has been a lot of change for many of our members, and we want to thank you all for your patience while we completed this work. This change has also meant that we've experienced higher volumes of inquiries to our contact centre, which has meant our call wait times have been longer than normal. We do apologise for this, and we assure you this will improve into the future. Indeed, we are seeing improvements now. We're now a proud fund that manages over $30 billion in assets on behalf of over 250,000 members. This merger brings scale and efficiencies to how we operate. The Brighter Super brand name is just a year old, but as you know, our Queensland heritage dates back to 1965 when the organisation was first formed. We remain a proud Queensland-based fund and are in fact the fourth largest non-government financial institution in Queensland, serving Australians everywhere. We're classified as an industry fund and we have specialist insurance products for our local government and energy sector members. With the Suncorp merger, we're now also catering for the financial services sector, which is a really exciting move for all of us. You'll see that our promise is to be right by your side, and by this we mean we come to you whenever we can. We have over 40 superannuation specialists who travel around Queensland and nationally, providing opportunities for you to meet with a real person and discuss what is likely to be your second biggest asset after your family home. Our investment strategy is about creating and maintaining a diversified portfolio of assets, including listed shares and unlisted property and infrastructure, as well as cash. It's a strategy that's worked really well this financial year, and we're very proud of both our investment team and our results. Our MySuper option returned an impressive 10.62% in the 12 months to the end of June. And I'm really proud to say that this is the 5th highest return nationally in its class this financial year, and the highest return for a Queensland industry fund compared with our peers. As you can see from the screen, our other options have also performed admirably. The growth option has returned over 12.5%, and our Brighter Super balanced option has resulted in a return of over 10%. In fact, 10 Brighter Super accumulation options and 7 pension options finished in the top 5 best performing options in their category in the country. Earlier this year, Brighter Super was also awarded platinum ratings from Super Ratings, which is the highest possible rating you can get. For the 15th year in a row, we received platinum ratings for our accumulation account in the My Choice category and our pension account in the pension category. And for the 10th year in a row, we received a platinum rating for our MySuper investment option in the MySuper category. These ratings reflect value for money and the potential to maximise retirement savings in a well-serviced, secure environment. While it's great to see for many members that fees and costs are coming down, it's also important to consider how this compares with other mega funds in the industry. So recent changes in superannuation legislation have required funds to increase our disclosure around fees and costs, and we've taken this opportunity to review how we compare. I'm pleased to say our offerings to you, our members, compares favourably in the superannuation market. Our fund offers competitive insurance, which has largely been designed for the industry in which you work, and in some instances, the costs may be paid by your employer. We strongly suggest you talk to our team to understand all your fund benefits as well as fees and costs. Now that we're a single fund, there are some updates that I'd like to take this opportunity to highlight. So firstly, the introduction of auto rebalancing. Due to movements in the market and payments coming out of your account, over time, if you have multiple investment options in your account, your actual investment option asset allocation can differ from your intended investment strategy. Reviewing and rebalancing your investment options regularly may help to keep your investment strategy on track. So from the 1st of July, we introduced the option to have auto rebalancing applied to your accumulation account quarterly, 6-monthly or annually. And so this means that at your chosen frequency, we'll rebalance your investment options by switching them back into the percentage options that you last chose. Now, pension account members already had that option, but it was only available annually. So from July, pension account members also have the opportunity to nominate a quarterly or a 6-monthly auto rebalancing schedule. Secondly, our insurers. As a result of the merger between LGR Super and Energy Super, Brighter Super has had 2 separate insurers for our 2 key groups of members. Members employed by local government and associated industries have been insured by TAL, and members from the energy industry have been insured by Zurich. In July, Zurich was appointed as our lead insurer and has become the insurer for our local government and associated industries members as well as energy. It's been a great outcome. Despite this being an environment where insurance premiums are rising, there will be no changes to your premiums or cover, and we can directly put that back to our move to a single insurer. In partnership with Zurich, we'll also be implementing new discounted travel insurance for members through Covermore and access to a new health and wellbeing app called Live Well. For our former Suncorp Super Optimiser members, your insurance will continue to be with TAL, also at a great rate. We also understand how important it is for you to have access to financial advice. So advice is set to change in the coming years as the government has announced support for removing red tape and enabling super funds to provide more comprehensive and personal financial advice, particularly retirement income advice. So recognising the importance of advice for many of our members, we are refocusing many of our services to being advice-led. We've created a new team and suite of advice offerings for you to access. That's why we're now offering the option for you to pay fees to your independent financial advisors from your Brighter Super account. Previously, that option was only available for advisors employed by the fund. However, we do understand members sometimes choose to use an independent financial advisor. The acquisition of Suncorp Super has given us an even greater ability to deliver on our promise to offer individual, trusted and friendly advice and service to members through the expansion of our internal advice team and access to over 1,000 external financial advisors. Cyber. It is important to discuss how at Brighter Super we take your security very seriously. With high-profile cyber breaches last year, we do want to reassure you that keeping your data safe is a high priority for us, and we consistently look for ways to strengthen the security of your information. So you will have noticed that access to Member Online now requires multi-factor authentication. So that gives your account 2 layers of protection, your password and a one-time code. Multi-factor authentication has become a common feature in today's online world as businesses and organisations need to increase the protection of their customers' data. In fact, you're probably already using it regularly to access your account on other online services like banking, shopping or video streaming. But scammers do keep finding new ways to trick their unsuspecting targets, whether it be over email, social media, websites or telephone. Superannuation is a particularly attractive target, so we urge our members to be vigilant about online, phone and email scams. The government has announced changes for super as part of its recent federal budget. So we've got some of the changes here, and they include the fact that the superannuation guarantee rate that employers are required to pay into their employees' super has increased from 10.5% to 11%. The amount of super that can be moved into retirement phase was increased from $1.7 million to $1.9 million. For our members with pension accounts, the temporary reduction to minimum drawdown rates ended. That reduction was a COVID-19 relief measure. For our members on lower incomes, the income thresholds for the government super co-contribution has also changed, and you can find the latest information on the ATO website. So we continue to work with our regulators and government on changes in our members' best interests. Should you wish to read more about the government's proposals and what they could mean for your super, visit our website and read our recent article on the federal budget. Very excitingly, we've also recently launched new bite-sized webinars on a range of different topics, broadcast at different times of the day. So if you miss a topic, don't worry, as we'll continue to run these each month. To view the full list of upcoming and interactive webinars, please scan the QR code on your screen or visit our webpage, brightersuper.com.au/seminars. Wherever you are in your superannuation journey, you can be confident that we will be right by your side to support you. Thanks for listening. I'm now going to hand over to Mark to provide an economic and investment update. And after that, we'll be very pleased to answer your questions. Don't forget to submit a question, the little blue hand at the top of the screen.
Thanks, Kate, and good evening, everyone. It's a pleasure to be here this evening to talk about your super. I'm going to open up tonight, first of all, with how has your fund performed? Kate's given some detail, I'll give a little bit more. Then what has been happening in economies and investment markets and why is that driving your investments? And then I'll conclude with thoughts about what might be next. Before I start, I just have to provide some important disclosures about this table of performance information. All funds are ranked versus the SR50 or 25 category of major funds in the super rating survey, and as indicated by the asterisks when they are ranked by the relevant all fund comparison. Brighter super returns are reported on a basis of soft close valuations, net of investment manager fees, net of taxes and gross of member specific account administration fees. Past performance is not a reliable indicator of future performance. I'm pleased to say that in the past year, we have seen very strong performance of all our investment options. This slide shows performance for our accumulation My Super and Choice options. Both Brighter Super, the legacy LGIA and Energy Super members, and Optimiser legacy Suncorp members option performance is shown here. My Super returned 10.62%, fifth out of 50 funds in Super Ratings' My Super survey. The Optimiser High Growth Fund was ranked first in its category. All up, top quartile performance was recorded for most of the funds, along with top 10 performance as well. Pension options had similar strong performance numbers. The key driver of performance was Australian and international shares. Our funds have a bias towards shares and away from private equity investments. Performance was solid across all the asset classes as well. It's important to note that while fiscal year 22-23 had strong returns, this largely reversed early weakness. This chart here shows returns of the benchmarks for the various asset classes in the brighter super options, along with selected option returns. While equities were up around 15 to 20% in the last financial year, if we look over 18 months, there's little change. Asset classes such as fixed income and listed property and infrastructure are down over that period of time. My final slide on performance is to look at the long run returns. My Super over 10 years has returned 7.1%, more than 4% above inflation. Strong real returns. This is despite the net result of the past 18 months being a gain of only a couple of percent. So what's caused these wild swings in investment markets that we've seen in the past 18 months? And I'm sure I won't surprise you that it's got to do with COVID and how it's impacted our economy and our society. COVID brought lockdowns. It brought supply chain disruptions. It brought labour market shortages. It also brought massive government support of individuals and businesses. And it brought zero interest rates from the Reserve Bank. In addition to this, Russia's invasion of Ukraine was another shock we had to face as commodity prices of energy surged. We are still in a process of working through all of these distortions. First one I'll look at is the way we spend our money. This chart shows impact on consumer demand in the United States. The thick blue line shows goods consumption. The thinner blue line shows the trend pre-COVID. And pre-COVID, it was steady and smooth. But COVID saw demand in less than 12 months jump 20%, a massive change. No wonder inflation in goods prices rose sharply, as I'll discuss soon. And now demand has been tracking sideways for the past 2.5 years. Services demand has been steadily tracking higher, and it's close to its old trend now. If we look at Australian data, the story is pretty similar. COVID has also changed the way we save. This chart shows US and Australian savings rates. The vertical line is just before COVID. What's evident is that during COVID, savings surged. Now they are beginning to be run down. The big build-up in savings and the buffer it has provided to households and businesses explains the resilience we're seeing in economies up to this point in time. COVID also changed monetary policy. Interest rates in Australia and in the developed world were set at zero. Central banks also lost control of the money supply. In the United States, this was the most extreme. In this chart, what it shows is that money supply in the last couple of years has hit the strongest, second strongest it's been in the last 150 years. You can get too much of a good thing. The economy came out of balance, and this has led to inflation. In Australia, inflation has returned to higher levels. In Australia, it's running at 6.1%, as shown in this chart. That's the highest it's been in 30 years. Importantly, you should appreciate that it's not all homegrown. Inflation has a global dimension, as can be seen how tight the link is between Australian and US inflation. US inflation is currently 3.1% and now appears to be leading our inflation and others down as well. It's important to also understand that the easy inflation has a global dimension. This chart shows the cost of a 40-foot container box to major ports around the world. for shipping. As goods demand surged in the early days of COVID, demand skyrocketed, and what we saw was that the cost of shipping things around the world went ballistic. But as demand flattened out for goods, shipping costs have gone back to more normal levels. Supply chains are now more in line with history. And goods inflation is beginning to fall in Australia, as shown in this chart, with the blue, which is shown by the blue line. This in part reflects due to better supply chains and also due to falling commodity prices. But importantly, note that services inflation remains elevated. This is a global trend too. High services inflation has been supported by a pickup in wages growth. This reflects the low level of unemployment, which is now at its lowest level in more than a generation. And it's this which has the focus of the RBA and other central banks, such as the US Federal Reserve, when setting interest rates at the moment. What does this mean for interest rates? Well, central banks have all been on the same path of rapid rate rises in the past few years. They all missed the surge in inflation and so are now playing catch up. My expectation is that we're getting close to, if not at the peak in many countries, including Australia, on interest rates. Inflation is now falling. Growth is moderated, but still okay. Two more comments I'd like to make on interest rates. Firstly, the move up in interest rates has been historic. As this chart shows, interest rates in the United Kingdom have only just moved up off the lowest interest rate in the past 3,000 years, or at least 3,000 years. That's an historic development. Secondly, for Australia, the share of income devoted to interest payments has more than doubled in the past year. Interest payments have gone back to the GFC period high. If you look back into the first decade of the century, it took 7 years for the interest rate burden to rise that much. This time around, it's only taken a bit over 12 months. This clearly has to have a dampening impact on demand in the economy. So, where do we go from here? Markets fluctuate as participants shift their expectations about a range of factors. There's an economy's path of growth and inflation. There's technological change. At the company level, there's earnings and the prospects of that company thriving or declining. And the policy settings for governments and central banks are important as well. If we look back last year, the decline in markets was driven by concerns about a hard landing, high inflation, rapid rate hikes, and recession fears caused markets to fall. The rally in the past year has been driven by soft landing being embraced as inflation fell, rate hike expectations began to diminish, and growth in the economy remained resilient. Artificial intelligence and stocks related to it has also been a driving factor in the rally in share markets that we've seen. In fact, the so-called Magnificent Seven in the United States has accounted for the lion's share of the gains in the US share market in the past 12 months. Amongst all the noise of the share market, share prices are anchored by company profits. From here, I see a period ahead of moderate returns at best. Looking at the two extreme outcomes in my previous slide, for example, with a soft landing, with little easing up in the labour market, we're likely to see central banks keep rates high for a period of time. Growth prospects and returns will be constrained. If it's the other extreme, a harder landing, this means declining company earnings and means higher unemployment and economic distress, all of which are not a good combination for returns in the period ahead. In an uncertain world, diversification of your super across different types of investments is important. This colourful slide shows the performance for a range of asset classes for the past 15 years. Each asset class has a different colour, and they're ranked from best to worst. It changes greatly from year to year, as you can see. For example, in 2022, cash was the best asset. In 2021, it was developed market equities. In 2018, it was global fixed interest. We don't have a crystal clear view to where the economy or markets are going. So what's important is that we build diversified portfolios for you. Rather than putting all your eggs into one basket, what we look to do is to spread it round so you can benefit from a smoother ride, as shown by the dash line. The grey boxes in the chart here are an example of a diversified portfolio rather than just a single asset class. But importantly, what we also do is we also diversify by geography, where we invest your assets, your money. This chart shows the range of assets we have in Queensland, and they range from airports, light rail, and shopping centres, just to mention a few. Investments are also spread in other parts of Australia and around the world. In Australia, we have ports, we have real estate in Europe and the United States, we have renewable energy projects at home and overseas. There's still a working through of these distortions of COVID lying ahead. I believe interest rates are close to a peak though. The rally in share markets in the past years was based on raised expectations of a soft landing, plus the benefit of the rally in artificial intelligence stocks overseas. But labour markets are tight, wages growth elevated, and inflation is above target. Central banks are still walking a tightrope. It's really a balancing act between inflation and recession. Their success will be critical for investment returns in the year ahead.
Thanks so much, Mark. As always, absolutely fascinating to hear from you about the economy, and congratulations to you and the team on the performance of our investment options. It's been really, really wonderful. So we'll move now on to questions, and don't forget, if you want to ask a question, please click on the little blue hand on your screen. We will endeavour to get through as many of the questions as we possibly can in the time that we have remaining, but please just rest assured that if we don't get through yours, we will contact you over the next couple of days and just make sure that your questions are answered. So I have a question to start off for you, Mark, from Glyn Palmer. When interest rates start to reduce, will property and fixed interest be likely to outperform equities?
When interest rates are coming down, that's usually a time we'd expect when there's a moderation in economic growth. And during that period of time, that's when you normally get the benefits of holding bonds in your portfolio. Interest rates decline, that supports returns from bonds, and that normally is around the time when you're also getting weaker equity markets. So it doesn't always work out exactly that way, but at the moment, if inflation is easing, the Reserve Bank eases interest rates, I think you'll probably find that at that point, weaker economic conditions, we will be getting probably a benefit from bonds versus equities.
Thank you. Very clear, as always. I'll take the next one, I think. This one's from Mike. Mike is asking us, would Brighter Super be able to establish a specialist commodity fund that invests 100% in commodities and a specialist infrastructure fund, because we have no funds similar to either of these. First of all, look, we probably wouldn't be looking to do either of those. We don't have commodities as a specialist asset class, and in just a minute, Mark, I'll ask you to talk about why that might be. But we don't currently have commodities as an individual asset class. We have talked in the past about introducing a specialist infrastructure fund, but to be honest, our view is that the demand for that fund would not be sufficient, or for that investment option would not be sufficient for us to be able to deliver a good quality scale product that met the need of the members who are invested in it. So we're not looking to do that. Do you just want to talk about commodities for our members, Mark?
Look, I think one of the things about investing in the Australian share market is you actually get an inbuilt commodity exposure. In inflationary times, commodities are one asset class which does perform well. And I think if you look at the last 12 months or 18 months or so, the Australian share market outperformed through that period versus other markets because of that commodity exposure. So I think we're already getting the benefit of that commodity exposure, and so we don't feel we actually need, as some may overseas, to actually put a specialised allocation into the portfolio.
Thanks very much for that. That's absolutely fantastic. A question from Glyn. Will performance charts ever become available on the website? We have heard and understood the need for you to see your performance charts on the website, and that, I believe, is in the backlog of work to be delivered over the next period of time. I haven't got an exact time as to when we might be delivering that, but we do understand how important it is for people to be able to look at performance of their investment options when they wish to. Another question for you, Mark. So Ian asks, the SR balanced rating, or SR, we call it now, socially responsible fund, is a large abnormality as compared with the other brighter super metrics. And I guess the question that he's asked is, what has happened to that fund? Can you maybe talk about that and maybe talk about some of the plans?
Yep. In terms of the SR Balance Fund, that's our socially responsible fund. In that fund, the key difference between that and the rest of the fund, and other ones that you've seen there, is to do with the share market exposure. The share market exposure has significant exclusions, and particularly in the last 18 months, excluding carbon intensive industries, oil, gas and coal and the like, actually was a significant drag on performance. So that's really the difference in the fund. It was actually the underlying makeup of the portfolios to actually make it consistent with it's socially responsible, which was taken as you're worried about climate change, and we had a very significant exclusion, along with some other aspects, but that was really the key differentiator. And if we look around the market, I think we find that you've got fairly similar type of impact elsewhere.
Yeah, thanks very much, Mark. Absolutely. A question for me, as an average account holder, what should I do regularly to maintain a healthy account? The thing that we always say is that it is time in the market, not timing the market, and it's about making regular contributions to ensure that over time your balance grows. And it's the magic of compounding interest. If you're compounding returns, if you have money in for 20 years, you can get a massive uplift on the original value of that contribution, just through the returns multiplying around each other. So make it what we say is time in the market, and for good outcomes for members, it's really great to be putting regular contributions. Just a little bit extra every week does make an incredible difference. Mark, one for you. Richard asks, what percentage of investments does Brighter Super hold in unlisted assets, and how frequently are the value of those assets reassessed?
Across the fund as a whole, we have around 22 to 23% in unlisted assets. So in terms of those unlisted assets, it covers a range of property, infrastructure, private equity, and credit instruments. The assets are generally valued very regularly. That we're seeing a lot of the assets are valued on a quarterly basis, and we track very closely the valuations as they come in, and actually work with our managers to understand what is going on in the assets. So yes, they're not traded every day, but there are regular updates on the prices, and we actually interact with our managers to understand what is going on.
Yeah, thanks for that, Mark. And Tom actually asks a similar question to this, which is, compared with other industry funds, we have a relatively high exposure to unlisted assets, in particular real estate. So how are we prepared for the proposed regulatory changes for more transparency on unlisted asset pricing? The answer is we've had a really significant focus on that, both from the investment team, but also our separate investment operations team, who does monitoring of the valuations for us. And it is something that we've also spent quite a lot of time reviewing from a governance perspective, all the way from the board through the investment committee to our executive team. So we're very comfortable that we're interrogating those assets and their asset pricing with sufficient frequency, that we understand how that works. We have codes as to the protocols and practices we expect from our managers, and it is a very important thing that we spend some time on. So thank you for that. So another question for you, Mark, please. Does Brighter Super, Trish asks this one, does Brighter Super invest in the Magnificent Seven?
If we look at our managers, we will have, generally the style of our managers has not been to be in those high growth stocks. But interestingly, what we are finding is that we have managers who we might view as different styles, like a growth manager, someone who likes companies with fast growing earnings. And compared to a value manager is someone who likes to buy cheap companies, doesn't worry necessarily about how quick earnings growth is. We actually currently have we have in the same global equity portfolio, we have these different style managers and they're both holding it. So look, we do hold some of those stocks. But it's an interesting time because what we're finding is that managers who've got completely different ways of viewing it are buying the same stock.
Thank you for that. Question that I'll answer, does Brighter Super invest in coal and gas? The answer is yes, we do. So we believe in responsible investment and readying the world for transition. And we don't think that divestment, that is selling coal and gas companies, actually is responsible investment. What we're more interested in is making sure that we talk to our managers to ensure that they are working with the companies in which they are investing to make that transition to reduce climate emissions. So it is something that we take very seriously, but we do not divest and we do not exclude, with the exception being the socially responsible option, which Mark spoke about earlier today. So Mark, given the significant, this is from Rod, given the significant property investment portfolio that Brighter Super has, why is the property component currently performing so sluggishly?
If we look at what's going on in the property market, with the increase in interest rates which have occurred, a very large rise that we've seen, that's actually putting pressure, downward pressure on property. It's a comparison game between the yield on property versus the yield on interest rates. As interest rates go up, the bar for property becomes high to outperform, and that's leading to decreases in valuation. The other factor as well is that when we look at property, compared to a number of areas, it's actually been quite negatively impacted by the event of COVID. And particularly to do in the office sector, and the impact that's actually happening on people working from home rather than the office, which is decreasing demand. So two things have gone on. One is COVID's impacted demand for office space, and higher interest rates basically, as a relative sense, makes it more challenging for the property sector. Probably the good thing in our property portfolio, the most heavily impacted area is in office, and office is the area where we've been sort of less than sort of the benchmark weight.
Great. Ian asks us, or comments, it would be fantastic for the fund to provide members with early advice of when they're approaching the concessional contribution cap each year. So is that being considered, and when is it likely to occur? So we do, generally speaking, do a campaign, in March or little around that time each year, which does alert people who are approaching their concessional contribution cap. However, I do recognise that it can occur earlier during the year. So thank you for that feedback. That is something that we will take on board. Mark asks this, what is Brighter Super's position on the federal government's push for greater investment in a number of key policy areas, which include social housing and renewable energy investments?
We're always happy to look at investments and consider them on their merits. And for us, every investment we look at for our members, it comes down to what's in members' best financial interest. And we'd like to support We like to support the energy transition. We've got a lot of energy members out there, from the old energy members. We also realise the issue in terms of social housing around Australia, but ultimately we're focused on making investments which are best for you. So hopefully government's desires can come together with returns.
Absolutely. That has been one of the challenges to date. We do have some quite significant renewable energy investments in our portfolio, including, I think, an investment in Queensland, which is nice,
Yep.
and in partnership with QIC, Queensland Investment Corporation, which is one of our key partner providers. It is, as Mark says, the most important thing that we have to do for you is to provide you with a really great outcome for your retirement, and so that means that we prioritise making sure that the rate, that the returns on that investment are sufficient for us to do that. So we've come to the end of our questions. Thank you very much for your questions and for your time this evening. Before concluding, I do want to remind you that our fund is open to everybody. Do you mind just clicking that for me, please? Thank you. Brighter Super has a proud history of serving members in local government and the energy and electrical sectors, and now, of course, through Suncorp Super in the financial services sector. As an open fund, we do welcome members from many other sectors and across the wider community. So to learn how your spouse, friends and broader family can join and take advantage of some of these wonderful returns that Mark is delivering us with his team, please go to brightersuper.com.au. We'd also like to remind you of our family and friends offer. So former LGR Super and Energy Super members have long enjoyed this, and from September we are excited to extend this to our former Suncorp Super members. So to start referring other people, simply log into your member online account and retrieve your personal referral link, and you could receive a $100 voucher. So we really value your feedback, and we'd appreciate it if you could leave us a Google review or a product review. Please simply scan the QR code on your screen. These reviews assist us with our brand recognition and customer service, so we'd really greatly appreciate your feedback. We also encourage you to follow us on LinkedIn, Facebook and Instagram for the latest updates on our news, webinars and all things super. So that draws to a close our webinar this evening. I do hope the presentation was beneficial for you and that you can see that we'll continue to work very hard for your best interests, and particularly your best financial interests into retirement. Thanks again for attending, and have a terrific evening.